If you've been thinking about investing but have no idea where to start, you're not alone. Most people feel the same way, intimidated by all the jargon and the worry of making an expensive mistake. But here's the good news. Building a profitable investment portfolio doesn't have to be complicated, and it can start with $10 a day. In today's video, I'm going to walk you through a simple step-by-step guide to creating a monster dividend portfolio. You don't need a big bankroll. You don't need a finance degree. It just comes down to 3 questions. How many stocks you need to own, how much money goes into each one, and how you spread them across sectors so that one bad year in one industry doesn't take the whole thing down with it. I'll show you the exact 16 stocks I picked and the workflow I used to find them. And by the end, you'll see how $10 a day in this monster portfolio is projected to reach $1.4 million, paying over $5,000 a month in dividend income every month without selling a single share. But first, why do you even need a portfolio at all? Why not just park the money somewhere safe or find one great company and let it ride? Here's the thing about playing it safe. Say you've got $1 million sitting in bonds paying 5%. Well, that's $50,000 a year, and honestly, it's about as safe as money gets. The market can fall apart, and your income doesn't budge. But run it forward 12 years at 3% inflation? That $50,000 is still $50,000, but now it only buys about $35,000 worth of life. Because thanks to inflation, everything costs more. Oh, and that's before tax. Take 30% off the top, and you're living on just under $25,000. Half. That's what's left. So is $25,000 a year enough for you to live on? And that's just inflation. There's also what happens when you bet everything on one company. Remember Enron? People had their whole retirement sitting in that one stock. Or Lehman Brothers, 158 years old, survived the Great Depression and then just gone over a weekend. Own a piece of everything instead, and for every business having a catastrophic year, you own another one having the best year of its life. They cancel each other out. As long as America keeps showing up for work, a portfolio like that is pretty much never going to zero. Obviously, you can't go out and buy every stock in the market, not without an ETF anyway, but you can own more than 2 or 3, depending on your risk level. So building a monster dividend portfolio starts with understanding what's actually driving your risk. I've boiled it down to 3 steps, and the first one is the question almost everybody gets wrong. How many stocks do you actually need? Before I answer that, quick word about today's sponsor who made this video possible, investing.com. We all know them, but today I want to show you their flagship product, Investing Pro. In a couple of minutes, I'll show you how I used this exact tool to pick the stocks for my portfolio. Here's what it actually does. You know how researching one company turns into like 8 tabs, a spreadsheet, and 3 different sites wanting you to sign up before they'll show you a single number? That's an afternoon for one company. Investing Pro puts the whole thing on one page. The screener takes every company in the market and filters it down to the handful that match exactly what you're after. Pro picks AI for stock ideas. And then there's loads of company info in here you won't get anywhere else. Fair value's the big one. Single number tells you if you're overpaying today. There's a health score. They've built an AI into it called Warren AI, where you can ask any question about any stock, and it goes and does the research for you. And the timing on this is good. Right now, they're running a sale, 60% off Investing Pro. But if you use my link in the description or pinned comment, or use my code John's Money Adventures at the checkout, you'll get another 15% on top of that. That's the best price you can get, and it won't be around long, so go grab that link. Okay, so back to question 1. How many stocks do you actually need for a monster dividend portfolio? Some of the best investors alive run concentrated portfolios, 10 positions, sometimes fewer. Buffett's famous line is that diversification is protection against ignorance. And for him, he's right. But here's the part that matters for you and me. Buffett has a research team, 50 years of relationships, and a phone that gets picked up by any CEO in America. We, on the other hand, are on the outside looking in. We don't get a call back. So I'd rather spread my bets than blow up my retirement on one conviction that turned out to be wrong. And the fewer stocks you own, the further your results drift from the markets. Sometimes that drift goes your way. Sometimes it very much doesn't. People have been chewing on this exact question for 50 years. So let's look at what they actually found. The American Association of Individual Investors ran the numbers back in 2004. Every publicly traded stock, 1960 through 2001. And what they found is that owning one single stock instead of a properly diversified portfolio adds roughly 30 percentage points to your annual volatility. So instead of riding the market's normal 15%, you're riding 45% by owning just one stock. Put plainly, on average, a one-stock investor watches their returns swing about 35% above or below the market in a typical year. 35% in a normal year. Their rule of thumb went like this: holding 25 stocks kills about 80% of the risk you can actually diversify away. 100 stocks get you about 90%, and 400 stocks get you to 95%. Then a more recent study looked at 5 developed markets: the US, the UK, Japan, Canada, and Australia. Same direction, tougher answer. In the US, to be confident you've killed 90% of that risk, 90% of the time, you'd need around 33 to 55 stocks on average. And when markets get ugly and everything starts falling together, that number climbs past 110. Okay, so up to 55 stocks. But realistically, are you going to research and keep track of 55 different companies on a Tuesday night after work? Yeah, no, me neither. So for someone who wants real diversification without it turning into a second job, the sweet spot lands somewhere between 10 and 25 companies. Enough to be genuinely spread out, few enough that you can actually know what you own. I went with 16. So that's rule number 1, how many stocks to own, and it's the one that keeps you in the game. 2 more to go. And then I'll show you that 16-stock portfolio and how it's projected to turn $10 a day into a $1.4 million portfolio that pays over $5,000 a month in dividend income. But right now there's an objection forming in your head. I can see it. And honestly, it's a good one. You're thinking, 16 stocks? That seems like a lot of work. Why not just buy an index fund and be done with it? Wouldn't that be safer, better diversified, probably even cheaper on top? Well, maybe. Honestly, for a lot of people, yes. If you want the simplest thing that works, buy a total market ETF, set up an automatic transfer, and go live your life. That is a completely legitimate answer, and I'd never argue with anyone who picked it. But that's not what this portfolio is built for. My goal here is dividends, specifically dividend income I can actually live on when I stop working, income that grows every single year from companies that have been raising their payouts for decades. And here's the thing about a fund. It pays what it pays. You get the fund's dividend yield, and that's your ceiling. You can't turn it up without tying up every dollar you've got. When you own these companies themselves, you decide what the income looks like. You choose the yield, you choose the growth rate, you choose which industries you're comfortable with. So it's a trade. The ETF is simpler, and it'll probably do just fine for most people. Choosing the stocks yourself and building your own portfolio takes more work, but you get to decide exactly what the paycheck looks like at the end of it. Me? I like the second one. That's a preference, not a fact. So now we know how many stocks. We've addressed the objection in your head about just buying an ETF. Now the question is, how much goes into each one of these stocks? Because this is where people wreck a perfectly good portfolio without ever even realizing they did it. Yogi Berra from the Yankees had a line. He said, It's tough to make predictions, especially about the future. He was talking about baseball. He might as well have been talking about this. When I build a dividend portfolio from scratch, I put roughly the same dollar amount into every position, equal weight. And the reason is a little uncomfortable. I don't know which of these 16 is going to be the winner, and neither do you. The market's pretty efficient over long stretches. That's exactly why professional fund managers with millions in research budgets and whole teams of analysts still can't reliably beat their own benchmark year after year. They're not stupid. It's just the future doesn't always cooperate. And if they can't call it, what makes us think we can? So we spread it out evenly. That way you can't accidentally put 40% of your money into the one that turns out to be a dud. Let's make it real. $10 a day is $3,650 a year. Split that across 16 companies, and you're putting about $228 into each one every year. That's $19 a month per stock. That's the whole strategy. The thing is, you could do all of that, own 16 companies, weight every one of them perfectly, and still end up with a portfolio that isn't diversified at all. Here's how that happens. Owning more stocks cuts your risk, but only if those stocks aren't all doing the same thing. Companies in the same industry move together. They're exposed to the same forces, the same interest rates, the same commodity prices, the same regulations. So when one of those turns against them, they don't fall one at a time, they fall together. That's called correlation, and it's the reason a portfolio can look diversified on a spreadsheet, but behave like a single stock the moment things get rough. Picking companies from genuinely different industries is what breaks that up. When some sectors are struggling, others are doing just fine. Look at how the whole U.S. market splits up by sector. Technology is the giant. Close to 40% of the entire index sits inside that one sector. Everything else is a long way back. Financial services is at around 11%. Communication services about the same. Healthcare's down at 8%, and it drops off fast from there. So think about that for a second. The S&P 500, the thing everyone points to as the safe, boring, diversified option, has nearly 40 cents of every dollar riding on tech. That's the benchmark, and that's more concentration than I'm comfortable with. So my rule is simple. No more than 25% of the portfolio in any single sector, and I try to own companies that don't really overlap in what they do. That said, don't force it. If you can't find a good company in a sector at a price that makes sense, then skip the sector. Sector diversification is never worth overpaying for. And don't buy something you can't explain. Peter Lynch, who ran Fidelity's Magellan Fund, had the best test ever written for this. Never invest in any idea you can't illustrate with a crayon. For our 16, we ended up spread across 9 sectors, 2 companies in most of them. That puts the biggest single sector at 12.5% of the portfolio, half of my own limit. So there you go. That's the framework. How many, how much, how spread out. 3 rules. What the rules don't tell you is which companies to actually buy. So next up, which 16? Here's the thing about picking companies. The easiest time to avoid a mistake is before you make it. Your mom told you to look both ways before crossing the street. Same principle, more money. Set your criteria first. Decide exactly what you're looking for in writing before you put a single dollar anywhere. Then go find the companies that fit that criteria. And if nothing fits at a price you like, wait. More money gets lost by rushing a decision than ever gets lost sitting in your hands saying no. So what am I actually looking for? Blue chip companies with balance sheets that don't scare me. A dividend that's genuinely growing, not just sitting there. And a payout ratio low enough that the dividend isn't in danger if earnings have a bad quarter. That's the criteria, which leaves the hard part. How do you find those companies out of roughly 150,000 that exist? Well, you could do it by hand. It takes about a week, but you'll still miss things. Or you can do this. This is the Investing Pro Screener, and I'm going to build my criteria in real time, one filter at a time. Keep your eye on the number in the corner. We start with everything. 150,000 companies. First filter, United States. I want US listed companies. Second, dividend yield above 1.5%. It has to actually pay you something. Third, and this is the important one, dividend growth over the last 5 years above 8%. This is the engine of the entire portfolio. A dividend growing at 8% a year doubles roughly every 9 years. That's what turns pocket change into actual income. Fourth, a dividend growth streak longer than 10 years. So the company has raised its dividend every single year for over a decade, through 2020, through 2022. Fifth, payout ratio at or below 70%. In other words, they're paying out less than 70 cents of every dollar they earn, which means there's room left to keep raising that dividend. And last, a 10-year total return filter above 100%. So the stock had to actually perform. Look, a growing dividend attached to a dying company, that doesn't help anybody. So there we have it, 6 filters, 80 companies, from 150,000 stocks down to 80, and it took about 40 seconds. Now, let me sort these by streak. Longest dividend growth streak at the top. And look at number 1. Target, 55 consecutive years of dividend increases. 55! Target has raised its dividend every year since 1971, before the internet, before mobile phones, through 8 recessions, the dot-com crash, 2008, even a global pandemic. Never missed one. Let me open it up. So here's the whole company on one page. Dividend yield over 3%. It's paying around $4.6 a share every year. Payout ratio around 60%, so about 60 cents of every dollar they earn goes out to shareholders and 40 cents stays in the business. That's sustainable. In the overview page, you can see the fair value of the stock. Investing Pro runs 15 different valuation models on the company and tells you what the math says it's worth. As of the time of making this video, that's $141.50. Meanwhile, the stock's trading at $136.78. So 3.4% of upside. Basically fairly priced. Look at the uncertainty rating though. Low. The models agree with each other, and the range is tight, $128.96 to $164.98. And here's why. 34 analysts cover this stock. 34. Every professional on Wall Street is already looking at Target, which is exactly why there's no bargain sitting here. When 34 professionals are watching one company, the price doesn't get to wander far from the value. Great company, fair price, no edge. Now watch this. Let's look at one more company from the screener. AGM, Federal Agricultural Mortgage. Up 600% over 10 years. So what is it? Well, they're called Farmer Mac. When a farmer needs a loan to buy land or equipment, this is the company standing behind that money. Farmers keep farming, the company keeps getting paid. That's the business in one sentence, so it passes the crayon test. Dividend yield is over 3%, paying $6.40 a share. Payout ratio is around 42%. Compare that to Target's 60%. Farmer Mac is paying out roughly 42 cents of every dollar it earns, which means it is close to double the room to keep raising that dividend. Now, fair value. $258.13. The stock is sitting at $209.51. Okay, that's 23.2% of upside. And here's the reason. 3 analysts. 3. Target has 34, Farmer Mac has 3. That's the whole thing right there. Nobody's watching this company. And when nobody's watching, the price gets to drift away from the value. That's not a glitch in the market, that's where the opportunity actually lives. But let me be straight with you about the other side of it. The uncertainty rating on this one is low, not medium. And look at that spread. The models range from $166.97 all the way up to $407.42. They don't agree with each other. That's what happens when only 3 analysts and 5 models cover a company. So treat that 23.2% as a signal worth digging into, not a promise. But that's the entire point of this exercise, really. I found a company I never would have heard of with a 14-year dividend streak, growing its dividend at 13% a year, and it only took me 2 clicks. That's the workflow. 6 filters and a couple of clicks. Want to run this yourself? Check fair value and financial health on any stock before you buy. Investing.com summer sale is live up to 60% off, and my code, John's Money Adventures, stacks another 15% on top, the lowest price all year. First link in the description, pinned in the comments. It's ending soon, don't miss out. All right, back to the list. To keep the video from dragging on too long, I've shortlisted 16 stocks across 9 sectors from the 80 stocks the screener gave me. None of them breaks the 25% sector rule. And here they are. Consumer discretionary, Lowe's and Domino's. Financials, Primerica and Farmer Mac, the one we just looked at. Utilities, NextEra Energy and Chesapeake Utilities. Industrials, Rollins and Masco. Rollins is Orkin, the pest people. Masco makes Behr Paint and Delta Faucets. Their products are in your house right now. Healthcare, Elevance, which you'd know as Anthem, and United Health. Technology, Intuit, who make TurboTax and QuickBooks, and CDW. Materials, Silgan and Avery Dennison. Silgan makes the can your soup comes in. Avery makes the label stuck to almost everything you buy. Consumer staples, Target, 55-year streak. And real estate, Terreno Realty, who own the warehouses your packages sit in before they get to your door. 16 companies, 9 sectors. The biggest sector is 12.5% of the portfolio. And there's a reason I just told you what every one of these companies actually does. You should be able to explain every position you own in one sentence. If you can't, you probably shouldn't own it. That's the list. Now run all 16 of these together, and the portfolio settles at a 2.29% dividend yield, a 13.39% dividend growth rate, and 10.56% average annual share price appreciation. And that middle number is the one doing the heavy lifting in the future. Let's see what $10 a day looks like in this portfolio over the long run. By the end of year 1, you'd have invested around $3,650. By year 10, the account is projected to reach $68,117. You'd have put in $36,500 of that yourself. The other $31,617 comes from the portfolio growth and reinvested dividends. By year 20, it lands at $323,497. So you'd have contributed $73,000. Everything else, $250,000, the portfolio builds for you. And after 30 years, the portfolio is projected to sit at $1,395,775 from $10 a day. Over those 30 years, you'd put in $109,500. The portfolio would add $1,286,275 on top. About $905,504 of that comes from the share prices rising. The other $380,770 comes from dividends, buying more shares, which pay more dividends, which buy more shares. That's the snowball. And that's the entire game. And the income? By year 30, this portfolio is projected to pay $61,873 a year in dividends, which is $5,156 every month without selling a single share. That's a mortgage, a car payment, and the groceries covered by something you'd build $10 at a time. And that's just $10 a day. If you can do more than that, the whole thing scales with you. Now, earlier I told you that if you just want the simplest thing that works, an index fund is a completely legitimate answer. And I meant it. So if I had to wipe the slate clean and start over from zero in 2026, there are exactly 2 index funds I would buy. That video is on screen right now.